We hear a lot today about, should I buy down my mortgage interest rate? Should I take this offer from the seller to do a temporary buy down? And I think a lot of people are just trying to figure out, what is even a buy down? What do you mean buy down a rate? I want to clear up the myths and the mystery behind buying down a mortgage rate. Let's say rates are 7%. I'm not saying that's what they are today, but let's just use 7% because it's an easy number for me to demonstrate buy downs. There's what's called a permanent buy down. You're going to take extra funds from either yourself, the seller, the real estate agent. There's a lot of different places it can come from. And you're going to buy the rate from 7 to 6. Now, there's an associated cost to get it to 6%. When I work with somebody on a permanent buy down, I look at how much is it going to cost to do it, how much is it going to save you monthly, and then we figure out what it's going to take to recapture that. And when I say that, let's say your payment's going to go down $100 a month, but you're going to spend $5,000 to save $100 a month. If you took that $100 and put it in a savings account, it's going to take 50 months to get your $5,000 back. Doesn't make a lot of sense in my mind. I like to see 24 months or less. That makes sense because in 24 months, mortgage rates probably aren't going to move enough to where doing a refinance makes sense. In 50 months, rates are going to come down enough, you're going to refinance, and then that money you spent to buy down the rate, you might as well just set it on a fire in a trash can. We hear a lot of people talking about temporary buy downs. 3-2-1 buy down, 2-1 buy down, 1-1-1 buy down. The news is talking about it. Real estate agents are talking about it. Listings have it all over it. Seller willing to pay for this buy down. What does that mean? Well, first of all, it's temporary. Let's say you're doing a 2-1 buy down. What does that mean? Well, the first year, the rate's going to be 2% lower. The second year, the rate's going to be 1% lower. So if we're at 7%, the first year, your payment's going to be figured on 5%. Second year is going to be figured at 6%, and then the third year you go to the 7%, but you have to qualify at 7%. There's no such thing as a free temporary buy down. Somebody has to pay for it. Almost always the seller is the one that has to pay for it. All they're doing is figuring the difference in the payment. So let's say from 7% to 5%, your payment is $200 a month less. Over 12 months, that's $2,400. And then from 7% to 6%, the second year, your payment is $100 a month less. That's $1,200. So $2,400 and $1,200, $3,600. The seller's going to pay $3,600. Now, all the lender's going to do is take that money, put it in a reserve account. You're going to make your first payment at $200 less than it should be, and they're going to take $200 out of that reserve account and add it to your payment. You're not getting a lower rate. The seller is paying part of your interest for the first 2 years. It could be a great program for somebody that may only be in the home for 2 years. Maybe you're only going to be in it for 1. Maybe a 3-2-1 makes sense because you're going to be in the home for 3 years. But you've got to be prepared that on the 13th month, your payment's going up. On the 24th month, your payment is going up. And you have to be ready for that change when you do a temporary buy down. Over my 30 years of mortgage experience of seeing the temporary buy downs come in and out of the market 4 times, I've never been a big fan of them. If the seller's willing to give you $3,200 for a temporary buy down, let's look at a permanent buy down. Maybe $3,200 to get you from 7 to 6.25 and save you $90 a month every single month until you're ready to refi or sell, and you don't have to worry about the payment going up. Buying down your rate could really make sense, but there's math that has to be done. You need an expert that can look at all the options for you and figure out what makes the most sense for your unique home buying situation at that time. Maybe it makes more sense to take that seller's contribution and just pay your closing costs with it. And then the money that you're saving on the closing costs, you put towards down payment. A lot of times, adding towards your down payment is going to bring your payment down quicker than buying down your mortgage rate.